Hi there, my name is Adrian, and I'm here to talk about some of the things that Teresa talked about, but I'm going to avoid that because she already talked about them. So I'm going to start with introducing to you a product that we've been popularizing around Europe. We started developing in Hungary at the end of the 90s, which was a very interesting period in lending history. Because of the peculiar situations that came up with the banks after the communism has fallen in the Eastern Bloc. And I'm going to concentrate on this product, and I'm going to, which is basically a carrot. It's a carrot for the mule, and it's one of the many. And I'm going to talk about what we did in Hungary and what are we doing currently in the UK, because we are working across Europe in trying to replicate the model and also supporting other viable models, or at least models that we found to be viable through their implementation. One of the first comments that I want to make is that we also face the same problems as any other developer, any other agency, any other third party who is interested in trying to work with commercial banks and encouraging them to create financial tools, or at least replicate financial tools that could serve this market. And our biggest problem, as I've mentioned in my first comment during the previous session, are basically the toothless policies that we see all around Europe. And these policies are toothless because, first, not only because they are not mandatory, but also because they are not mandatory, it doesn't involve the much needed financial support from the public funding that the private funds would need to work. So, some of the key issues I think Teresa also mentioned. Why is it that the banking sector is not serving this? Can I ask Adrian to sign me when I have 2 minutes? Yes. So some of the issues that Teresa also mentioned with the commercial banks is, why is it that today commercial banks are not able to serve this market? Why is it that homeowners are not taking up these loans? Why aren't they investing in? When there is so much evidence, there is so much studies done by so many universities and research centers. So there's a very strong science, economical as well as environmental science, behind the fact that we need to go towards refurbishment. And this is not happening. And although it's happening to some level, and we have seen in the previous session some percentages about how many buildings are renovated per year in Europe, these are very confusing numbers. Often because, for example, we do not consider the privately owned buildings. We consider in the West the social housing sector, who is doing a lot on this topic. And they are driving many of the numbers that we are seeing. But in reality, when it comes to the privately owned homes, not much is done about it. Many of the European funds that were dedicated towards supporting this kind of investment alongside the banking products were designed in a way that only social housing providers were able to access them. And we worked with them in the UK to develop the project. So there are all these factors that we need to take into consideration, and it's quite logical that the outcome will be that nothing really happened. So very little happened, and whatever happened in the refurbishment market was done at a very low percentage. So when we talk about that buildings were refurbished, if we go in depth to what quality, whether they were monitored, and what kind of effect they've got at the end, it's quite low. And one of the main problems is, as Teresa mentioned, is that banks would need to capitalize on the future cash flow. They've tried to introduce similar models in different countries, and they haven't always been very successful. It's also true that since 2008, since 2007, since the entire credit crunch and recession started, banks are less willing to go towards anything that they think it's new and thus risky. Although the credit crunch itself has shown that traditional products are not more secure. they can be a huge catastrophe. They can cause huge losses to millions of people. And still today, banks are locked into these traditional models. So yeah, we've developed this kind of product in Hungary, and the reason why we did it is that in the Eastern European bloc, you do not have such a huge will of people to take up loans, any kind of loans, mortgage loans or any other kind of loans. So the banks, at the end of the 90s, they were watching the market and they were seeing all this potential, but they didn't know what to do with it because people were not taking up loans. Especially, they were not taking up mortgage loans. One of the main reasons being is that the high private ownership of buildings, which is around 94% in Hungary, and it's about the same level all over Eastern Europe. So they had this huge problem of not accessing the market. And then the energy efficiency came in as a thought, and people started talking about it, and different agencies started to talk about it, and what kind of solution it might represent, what kind of problems we might be able to solve, what kind of in-depth, so what kind of investment we could support with it, and what are going to be the results. And basically, we created this model in a way that it's very flexible. It doesn't require it's not built up for a very specific market. It has basically on the top, there is someone who provides who provides a basic fund that works as a guarantor towards the commercial bank. And the commercial bank, thus, has a reduced risk when they are lending towards these projects. And this, of course, this model was created mainly for energy efficiency. It could have been used for other targets as well. But in energy efficiency, we've used this model because of two reasons. One, banks, when they assess the risks, they are very, very pragmatic on paper, but they are not so realistic in life. And very often they overreact to risks. And when it comes to energy efficiency and renewable energy investments in the building sector, they qualify the risks. So what they needed, at least in Eastern Europe back then, and now we are working on the same model in the UK and some other countries, is that they needed something to help them go beyond that level where they do not trust the market. So they have an extra guarantee to build up the portfolio, as Teresa said, and then grow from there. Teresa also mentioned one of the, and basically this model works mainly in multi-residential buildings because it was much easier to create a banking product that doesn't require a mortgage credit. Guarantee, because this was the main problem in Eastern Europe. People were not willing to put mortgages on their home because they were seeing it as a risk or existential risks. So they were seeing the mortgage credit as something that was threatening their existential by, for example, all the horrors that we hear when people default on their loans and then they are thrown out of their homes. So this was one of the reasons why they were not willing to take up mortgage credits. And in the case of multi-residential buildings, we created this product in a way to, due to the guarantee, to reduce the risk for the bank, so the bank doesn't need the mortgage guarantee mitigation tool anymore. So they could lend on. And Teresa mentioned that there is very little evidence about energy efficiency financial products and how efficient they are. This is not true for Eastern Europe. In Eastern Europe, we have several banks who have been working in this sector for more than 12 years, who have a large portfolio of energy efficiency refurbishment. These products are mainly related to the guarantee fund model, but there is another complementary model, which is interest rate subsidy on the loan, which is also quite successful. It's also used by the KfW in Germany, So there is a lot of evidence on the fact that first, they are successful, that they have very little default on the projects, and that and that the risk assessments of the banks were very unrealistic. So one of the numbers that we have are from the World Bank, which used to operate their fund, and they had close to zero default on any of their loans. And we also talked to different commercial banks, especially after the credit crunch, and their numbers are showing that this was one of the type of loans that was almost not affected by the crunch at all. So there were no defaults, extra defaults after the credit crunch either. And these are some of the projects that we worked with in the UK. We started working in the UK right before the credit crunch came in 2007, and it all looked bright and happy and pink, and everyone thought that, oh, this is such a nice model, let's do it and let's go and move and so on. And then the credit crunch came in, banks lost their ground, people were kicked out of their jobs and so on. And then everything slowed down, and in the last 2 years we started going upwards again. And I'm a bit worried about what's happening in the US, because that might come in Europe in a year or so, and it might take the market down again. So we are working right now in our main project is in northwest of England. We have 3 municipalities, because this is something that we discovered when we were working on the model, that first of all, development banks were up there creating the guarantee fund. But then we realized that there are other participants who could do that. And in some cases, ministries and governments started doing that, like in Estonia. But then we realized that there is someone who has a great potential, and whose potential could be unlocked, first because they have very close relationship with the buildings on their territory, and because they act very locally, and these are the local authorities. And then we started working in different regions with local authorities. We've worked with local authorities, and we try to convince them that they are in the perfect position to communicate between the private homeowners and the banks and even the government. So they are like right there in the middle, and because of that they could do so much more. And together with an energy agency, a regional energy agency there, we started developing this project, and which is the third one. We will have publicly available data next year, because the implementation is happening right now. We are refurbishing around 300 buildings. All the data is there, which is available now. But next year we will have more data on the results, on the implementation, on the concrete implementation, and so on. They were very excited, but I have to say that working with commercial banks, it's very, 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 very difficult. And the reason is that they lack this kind of specialized people or specialized departments who understand this kind of field. And even the biggest banks lack them. And in some instances, like I said, in Eastern European banking, we have much more expertise. We have much more knowledge when it comes to these risks, and they are investing much more they would invest much more if they would have this kind of scheme and this kind of public funding in addition. And these are the kinds of projects that we did in Hungary. It's mainly with multi-residential buildings, because they represent a huge part of the consumer, and also they have great potential when it comes to refurbishment. This is another project, and yes. So my last words are going to be, although I could talk for hours as well. And I don't know about you, but whenever I'm at a conference and I hear people sharing so many good ideas, my head is all in a jumble. And I want to make a prediction, and my main prediction would be that the housing sector, the building sector, as we see it today, will not be refurbished by these toothless policies. They will not be. The last 20 years have shown this quite evidently, that it will not happen. And it will also not happen if we do not consider this sector as important as education or healthcare. And our energy commissioner has said something about this about 2 years ago, that Well, we think that this will be very expensive. It might be as expensive as health and education. And I agree with him. It probably will. Because commercial banks and the market on its own and the homeowners on their own, they will not be able, with no matter how many tools we create on their own, to do these things. We need public funding. Even for this type of innovative finance, you still need some level of public funding, although it has a higher leverage scale compared to subsidies or direct grants. Thank you so much.